I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is October 13th.
Yes, not Friday the 13th, but October the 13th.
Yesterday,
we're not superstitious, right?
Yeah, not superstitious.
Yeah, but we can't say that. Right.
The inflation report came out yesterday, Thursday, October 12th, and we're going to go over what that means for the future mortgage rates.
Yes. Okay. So we got a couple great things here. I don't know why I'm so excited, but this is good stuff. We've been waiting for the CPI data, and we're going to have some food groups for you. Literally, food at home. You know, what has that done, increase-wise? Used cars, medical care, gasoline, home prices, and also how much have wages increased in the last 3 years? Are they keeping up with inflation?
So we're going to try to keep this very interesting because inflation really impacts us all. It affects us all. So we're going to get right into it with mortgage rates. Where are we at today? We have the 30-year fix at 7.69%, the 15-year fix at 7.02%.
Yep. And the FHA and VA are just lock and step. 30-year FHA, 7.15, and the 30-year VA, 7.16.
This is according to the Mortgage News Daily, where they take a survey of all of the, more or less, the majority of rate sheets, lenders, quoted rates.
Yep, across the entire country. So if you were to call the Mortgage Brothers, our rates will be lower than this, but we wanted to give you a baseline that's more nationwide.
Yeah.
To help you.
That's right. And just want to do a quick reminder that if you like what we're doing here, be sure to subscribe, comment, and like. We're always here to help you on your scenario, so be sure to reach out. And remember, this is for informational purposes only. This is not financial advice. And the CME is the Chicago Mercantile Exchange. This is where the futures options and futures shares are traded, and they do the best job, we believe, in kind of forecasting interest rate movements. But again, this thing changes every day, this forecast. And a lot of you are probably wondering, what in the world are all these numbers? What's really important is if you look at this, I think the biggest or the easiest way to explain it is this way. I've drew this green or turquoise line, this arrow. You notice it starts bending down right around June 2024. What this is showing is that the Fed will likely start lowering rates according to the futures traders in June of 2024. And Tom, I mean, we've been showing this for a long time, and there is a possibility between now and June of 2024 that rates may go up another quarter.
Right. Now, okay.
For the Fed.
Right. Okay. So we've got another 5 different meetings before we think it's going to pivot. Okay, this is one of the best crystal balls you're going to have. There's a lot of things, I guess, that you can get, forecasts on, but this is one of the most interesting pieces because you've got so many smart people in one room making bets on what they think, the Feds are going to do on the interest rates. Now, the important thing is this is what they're thinking today. It literally can change tomorrow, and I don't mean in that these percentages and probabilities changing, but I'm saying if something catastrophic were to happen, it could change this thing immediately.
Yeah. And I'm going to just speak to that real quick. I mean, right now with the horrible war in Israel, what's happened there will affect this in the coming weeks, months, and the year. I mean, everything globally is going to affect interest rates and what the Fed decides to do. Mm-hmm. And so, there's been major movement in this last week.
Right. Okay. Also, too, I think it's very, very important. Even if nothing changes and just the factor of time changes, and we start going from October to November to December, again, nothing is changing. Everything's the same. The closer we get to the point of pivot, things will force that change. Yeah. So you'll start to see that within the bond market, which is important. So it's not like we're not going to see anything move for the next 5 or 6 meetings. It will be moving, but it's moving in that pattern. Does that make sense?
Yeah, I mean, right, and it's going to move every day. And some days are bigger movements than others. It just depends on what.
Right. Yeah, and hopefully that made sense. Again, they're forget any type of bad news, any type of really good news. Come May 1st, when you're a month away from that pivot, you have already seen pivot moves in the rate. Where it's not all of a sudden going to show up, on June 11th. Oh, let's go pivot. No, they're working towards the pivot, even minute by minute. So it's just very, very fluid.
All right, so we want to show you the 10-year yield. Now, the 10-year yield is something that all trading markets look at. The global markets, pension funds, everything's wondering what is the 10-year doing. That is because it moves mortgage rates and any kind of interest rates that corporations are lending on and borrowing money on.
Do you know why they use the 10-year? Because 11 is too long and 9 is too short. I'm serious. It's that simple. 10 years is about about the bandwidth in which investors can analyze anything beyond it. It's just too far.
Yeah,
why don't you use the 50-year?
They're 10 years out.
It's just 10 years out.
Yeah. Beyond 10 years, it's kind of just impossible.
Yeah. So it's not scientific, actually. Yeah. It's very human. 10 years is where they like to go.
So the 10-year yield is showing that today we're about 4.7%. And the last time we were at 4.7% for that 10-year yield was back in 2008. It took about 12 and a half years to get to the bottom, which was about 0.5%. The 10-year yield got to 0.5%. It's been
0.5.
But it took 12.5%. Since that was the fall of 2020. Now, since 2020, again, it's only been 6.5 years that it took to get back to that 4.7. So this is what's very unique about where the 10-year and mortgage rates have come is how fast they've risen.
Yeah.
Things have risen so fast. What took 12.5 years has only taken 3.5 to come back up.
Yeah, and you can also go back down in probably 3.5 years. Or it could take longer, or it could take even shorter. Mm-hmm. I mean, there's probably a situation where within 1 year, you can see
in 2008 right here on this top left of this is when the recession was basically starting. Look how fast it plummeted. It came within just 1 year. It went from about 4.7 to about 2. So it did plummet. It rebounded, but that's during the recession. So if there's a recession and bad times for the markets, we should see these rates come down, which we do believe will happen. We really believe that this is time for a correction, that it will go back down, and the markets will show that it's like basically the Fed's work is done. Mm-hmm. They've risen, they've taken the rates, they've increased them. The markets are now stopping to spend money, and now we'll start seeing. That's the goal.
Yep.
And again, we expect all that to really happen in the June of 2024.
And if I can say this too, 30 seconds. For the first time, I read news in this last week in which the outside news affected long-term rates. And in no other time in the last year and a half, maybe a year, have I heard outside, effects pushing the long-term bond, because it's always been the Feds. The Feds. What are the Feds doing? Oh, meeting minutes. No, but with that Middle East conflict, all of a sudden the bond guys were like, okay, Fed, I don't really care what you're doing. Yeah. We're going to go in and bring down that rate. Everyone started flooding the bond market. So I thought it was really interesting, right? All we've been hearing about is, what are the Feds think? What are the Feds think? Well, all of a sudden this past week we got, what are the outside world?
Well, don't the traders in the outside world in the war in Israel, I mean, that's going to affect what the Fed's going to do.
That's right. So once the Feds see that the market's actually doing something on its own, then they don't have to do as much.
Yeah, because they're anticipating problems, financial problems. Mm-hmm. Markets not enjoying this, especially in the months to come.
Right. And a lot of the things that we've been talking about in our rooms have been doing with the equities, the actual companies. I hadn't quite heard it from the bond perspective, where yields were rising or dropping outside of any interference from the Feds.
Gotcha. Yeah.
Just the bonds were moving because of what the equities were doing. But this is a direct result of just people going to the bond. But
gotcha. Okay, so the inflation report that came out October 12th, yesterday, really, it was right on the forecast. The actual numbers for core inflation is 4.1%. And then total inflation is 3.7. Remember, core inflation is without food and gas. And so if you take out the food and gas from the inflation number, that's what the core is. And that last month, year over year, it was at 3.7. The forecast for this October release was going to be 3.7, and that's exactly what it came in at.
Yeah, so it could have been better news, which it came in lower, but it could have been worse news, which it could have come in higher, but it just came in right where they thought, which is like, so.
And I know a lot of people were probably like, oh, I thought I heard 4% or 3%. I mean, this is why you'll hear news agencies. I was reading different reports from the Wall Street Journal, CNN, MSNBC, and it was funny. There was a lot of, I could even see there was errors in the reporting. Anyway, it probably because it was, anyway, when you hear 4.1%, or if you did hear 4.1%, that was core inflation. Everything together is 3.7. So there was really nothing new or out of the ordinary. Now, this is called Truflation. It's a private company that puts together what they believe is inflation, and it's updated every second of every day. It analyzes I'm not sure if it's every second.
But like 10 million variables or something?
They're taking prices at the, whether it's at the pump, vehicles, Visa, MasterCards, they're looking at all these items and saying, okay, this is where the prices are at. They believe that total inflation year over year is 2.37, which is a lot lower. Well, about 1.5% lower than where inflation has been reported by the government. Now, I don't like that number. 2.37 does not seem realistic to me.
That doesn't fit in your head as something real.
Now, everything seems to be over the last year, 12 months. I believe the inflation is a lot more than 2.37. That's my personal experience when I go out there. And I don't know if that's something you've also experienced there in the audience, but
also we were talking about before the podcast was this is, again, a leading indicator, we believe.
Yeah, it's a leading indicator where they always are ahead. Meaning that when they report, they're usually higher or lower than where we're at. So they could be showing us where inflation's going.
Yeah. So in the next probably 2 months, ask us what we think about this because they may have hit it.
Yeah. I mean, when they were showing the interest rates falling back in December of last year in January, and that's exactly, we saw this decline right here actually happen.
You said interest rates mean inflation.
I mean inflation, yeah. So anyway, that's true. That's from Truflation. And this is an interesting number right here, 20.41%. That is what Truflation says that since October of 2020, the inflation, from that point, from that month, what inflation has been. That means if you bought something.
For 3 years.
3 years. Yeah, right. October 2020. The average product would cost 20% more.
Which kind of feels like at a minimum.
At a minimum, right. Yeah. I mean, so here is Charlie B here from Twitter. He's reported this today and thought this was really good because this is the same period of time over the last 3 years where we see that medical care, up 4.6%. See, that seems low, but apparel, 11%. U.S. wages have gone up 14% in the last 3 years. Yeah, but look at these big numbers. Food at home, 20%. Food away from home, so In-N-Out, Chick-fil-A, 21%. But look at the gas up 31%.
Home prices, 40. That sure makes sense.
Gas utilities, 31%. What was the?
I was looking at the home pricing. Pricing, 40%, third from the bottom. So that feels right. Yeah, that might even be a
since
little
October
bit,
2020.
A little bit low, maybe.
Gasoline's up 76%. So I mean,
some good categories here. Yeah. Actually, we want to use these in the future too.
Yeah,
because I think these are very relevant, buckets that we want to look at.
Over the last year, even though 3.7 is where the government inflation is at, a couple interesting things. Car insurance over the last 12 months, the 1 year is up 18.9% because stuff costs more. And I think the insurance companies are just always figure out a way to charge more.
Well, and also they're having a very hard time with, with some of these, states where they're just
California.
Simply pulling out of.
Yeah.
They just said, we cannot afford this anymore.
Florida with the hurricanes, they're having a difficult time paying, all the claims. Transportation and inflation is up 9.1% over the last 12 months. And, rent inflation 7.4%.
Now, what is homeowner inflation?
Homeowner inflation. Yeah, I think that's just. It's got to be I think it's just.
I don't know what that is. Buying trimmers for your bushes, paint for the mailbox.
Yeah.
Just okay.
So we want to show you this. That's from the Cobesia letter, the report. I hope I'm pronouncing that right. And this is again, inflation is important. It affects us all. We do hope that these inflation numbers come down because, and again, when they do, because they will have to come down, if the Fed's going to continue to put pressure on that Fed rate until people stop spending the money.
Yeah. And again, if the market can do it by itself, the Feds don't need to do anything else.
Yeah.
If the market doesn't do it on its own, then the Feds will need to come in and continue to do what they've been doing.
So if you like what we're doing, be sure to subscribe, comment, and like. Tom and I will keep up to date on inflation, all the important things that affect mortgage rates, and we'll be happy to help if you have any questions.
That's right. Give us a call too, folks. Thank you.
Take care.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.